When we think about all of these issues, several times I've referenced the U.S. economy, and I've come to the conclusion that we're expecting a positive economy, a growing economy. So let's just verify whether or not that's a smart assumption. You start with a picture of gross domestic product, which was down in the first quarter. In fact, it was down a lot. We just got the final word from the government that the GDP in the first quarter was down almost 3%. This after being up almost 4% as recently as last September. So there's been a big bounce down. And the question is, what caused that? And is it going to continue going down? The reason has been, in a nutshell, is that we had a really nasty winter. Most of our clients are in New England, and frankly, the New England winter wasn't all that different from normal. But if you think about the rest of the country, and you hear headlines like Chicago is colder than Mars, which is true, or you see that the entire state of Georgia has highways that are so frozen over that cars can't drive safely on them, or you read about the car lots in Memphis where they have snow on the cars and they don't know how to remove it and they can't sell them. All of these things and many others, and especially, by the way, frozen railroads in the Midwest, which really impeded travel and freight carriage, what you see is that there were significant delays in investment, significant delays in long-term purchases. Anything that could be put off was put off. So as a result, the economy really stalled and, in fact, went negative for the 3-month period. I think all of these are weather-related to one degree or another, and that many of them will bounce back over the course of the rest of this year. So if you look at the green portion of this chart, you'll see that our expectation is, in fact, for a recovery through the balance of this year. Let's go a little bit deeper dive into this, and you can see that government, what I'm showing you on the left is contribution. This is not percent change. This is how much it helped or hurt the economy. On the left was all of last year, and on the right is the first quarter of this year. And what you can see is that last year, the government was negative. That makes sense, right? There was a shutdown, there was a sequester, there was a dramatic reduction in defense expenditures as we pulled out of Asia. On the right, what's going on? Well, government is not going to be down as much. Why? Because a lot of those things have now been built into the system, and the continuing reduction this year is much more modest. On the left again, looking at last year, some very important private sector activities were very positive. Trade, housing, inventories, and consumption, all of those were very, very positive. On the right side, interestingly enough, all of them were negative, and that makes sense. When things when the winter is so cold that you can't go anywhere, nobody's investing, nobody's building new houses, everything stalls. Inventories went way down because companies couldn't restock because the transportation system was largely frozen. The only thing that kept growing was consumption. That is to say, people had to buy their groceries. They found a way to take care of the things that they needed to take care of. But now let's go beyond the big picture, what happened over a 3-month period, and look a little deeper into the biggest drivers of economic growth. What really matters in the economy? Well, one is housing, because housing is a big multiplier industry. A dollar spent on housing multiplies many times through the economy, probably better than almost any other sector. When you go back over the past few years, as I'll show you briefly here, the housing market is now set up to be much, much stronger. If you start at the top left here, what I'm showing you is the availability of homes for sale. It was very high in the crisis years because many people needed to get out of their homes. They needed to sell in order to raise cash when they lost their jobs or as the economy was falling apart. Eventually, a lot of those homes were foreclosed, and the banks were large sellers in this period. That's why there were so many homes on the market. Over time, the banks worked through their foreclosures. Many people decided that they could stay after all, and frankly, they had negative equity, so they couldn't really move anyway. And as a result, things started to stabilize. And you can see now that there are relatively few homes for sale. On the other hand, looking at the top right, mortgage rates followed interest rates. And over the past several years, they went straight down. So money got cheaper. And when you have cheaper money and fewer homes for sale, supply and demand suggests that, guess what, prices are going to go up. And so if you look at the green line on the bottom left chart, you'll see that, in fact, price change has been quite positive over the course of the past few years since the bottom. We haven't yet caught up all the way. If you look at the purple line, which shows the national price index, you'll see we're still somewhat below our peak. In the Boston area, by the way, that's not true. Boston pretty much has caught up with where it was. And when you have rising prices and relatively small inventory, guess what? Builders notice and they start building. And banks notice, so they start lending to builders and they start lending to individuals to buy. And so on the bottom right, you'll see that housing starts have begun to pick up nicely. But even so, there's a long way to go. We're now at the rate of roughly 1 million new homes a year being built, but the fundamental demand by 300+ million Americans is for about 1.5 million new homes. So it's still going to be tight for a while, and construction is still going to begin to revive and, in fact, begin to accelerate. That means probably that many more homes will be built, and that price appreciation may not be as fast as it was in the past couple of years. That's a healthy environment because that means more people will be able to buy new homes. Interestingly, the same dynamic applies in other areas as well. So let's look at durable goods, which are things that we buy that we are designed to last for a long period of time and are usually pretty big and expensive. Think here about cars and trucks and washing machines and furniture and plant equipment, all that kind of thing. When you look at durable goods, the green line here, by the way, is a month-to-month change, and it shows you absolutely nothing. It's just complete noise. If you look at the purple line, that's a 1-year change, and now you can see how severe that disastrous drop in 2008 was, and there was a bit of a recovery, but then things kind of petered out. Look at the red line. This is a 5-year rolling average, and you can see that through the course of the 90s and early 2000s, there was a bit of a cyclical upturn, but it wasn't huge. And then with the downturn, it just stopped. And for years, for 6 years now, we essentially have not done any investment into durable goods. And it's only in the past couple of months that you see that uptick in red at the far right. It's only in the past few months that we're starting to see the benefit of more spending on durable goods. If this continues, if this becomes a sustainable upturn, that would be phenomenal for the economy. And let's face it, if we haven't invested for 6 years, we've got a lot of old stuff that we need to replace. For example, look at the car and truck market. This shows you, notice the bottom isn't zero, it's 8 million a year. But what it shows you is that the demand for new cars was cut in half in the recession of 2008. And it's gradually worked itself back. But in the meantime, the average age of American cars is older than it's ever been. Yeah, cars are better. That's part of the reason. But part of the reason is that we couldn't afford, or banks wouldn't lend us the money to buy new cars. And our old cars are getting older, and that's not good. So we expect to see continued high sales, rising sales of cars and trucks. And the same is true for most other elements of the transportation business, by the way. When we start buying new cars, by the way, almost all new cars, or many new cars sold in the United States, are built here, even by companies with foreign nameplates. And so that means more jobs. Likewise, more housing means more jobs. On the next few charts, the left-hand side is going to be annual data going back to the late 70s, and the right-hand side is going to be monthly data for the last 3 years or so. Look at jobs. This is simply the number of jobs changing over the course of each period. And what you can see on the left, you saw the recession in 1982 was negative. Likewise, in 1991, when Bank of New England failed, that was a negative jobs. And then the biggest by far was the most recent one. But since then, we have seen steady job growth. Since February of 2011, as I show you here, it's been positive every single month. We have been adding jobs. Not as fast as we should, but nonetheless, we've been adding. And to give you an idea of why the speed matters, each of the lines on this chart shows you how quickly the economy recovered from the beginning of a recession. So each line represents one recession since World War II. They all start at the top left there at 0. That shows you what the peak jobs were right before a recession. And then running down the left side shows you what percent of jobs were lost. Some recessions were fairly shallow, didn't lose a lot of jobs, and they sometimes took a longer time, sometimes not, to recover, but on average probably about 2 years or 24 months. And on the bottom, the horizontal axis, which may be hard to read, is the number of months until we got back to that peak number of jobs. Look at the most recent one. That's the red line, the one that stands out apart from everything else. It is both much deeper than any recession we've had since World War II. In other words, we lost more jobs by a lot than any other recession, and it's taken much longer to recover. That's what I mean when I say this has been a long, slow recovery, and that only in the last month or two have we finally got back to where we started back in December of 2007. What that tells you is that people have been out of work for a long time. This chart here shows you the median number of weeks, that's the average number of weeks that people have been unemployed. And you can see on the left chart that there's an up and down movement, and that it was higher on in the recession years and a bit lower during the non-recession years. On the right, you can see that ever since the recession began, it has been way too high. People are out of work for much too long. And if you're talking about 20 to 25 weeks as an average, think about the people who are out of work longer than that average. That's half the people who are out of work. And when you pass whether it's 26 or 52 weeks, and depending on which state you live in, you stop getting your unemployment benefits. You're still looking for work, but increasingly, companies will say they don't want to hire you because you've been out of work too long, and states will no longer count you as unemployed, but instead simply no longer working. So that suggests the depth of what's going on here. Continuing, let's switch over and talk about inflation for a moment. And that's about all, because there is none. There are so many unemployed people that wages are not going to contribute to inflation for some time. Yes, there are a couple of companies here and there who are beginning to say that they're seeing some wage pressure, especially those companies that are require highly skilled workers. But you're not seeing any pressure from real estate in the form of factories or malls or commercial office space. None of that is particularly tight right now. The wage picture is not particularly tight. We're looking at 1 or 2% wage inflation. And even oil prices are temporarily high, but not likely to contribute to any long-term inflation. So here I'm showing you the CPI, or Consumer Price Index, going back 30 years, and you can see that it's pretty much staying very low. If you think about energy as one cause of inflation, and those of us with long memories remember from the 1970s that it was the biggest cause of inflation then. But the fracking boom and the shale boom of the past few years have changed that picture. This shows you U.S. production of oil in the dark line and natural gas in the lighter colored orange line has been skyrocketing, and in fact is at the highest level it's been in 20 years or more, 25 years. And so we are producing more energy. We're not yet a net exporter. That is to say, we still do depend on imported oil, but we depend less than we have before. Natural gas in particular is not a global commodity. It's very difficult, in fact, to ship it across borders. And so as a result, when you have that much natural gas production here, what's happening outside the United States doesn't matter as much, and you'll see prices continuing to stay low. Oil is quite easy, interestingly, to ship across countries, and so it's a global price. And when you have trouble in Iraq, or you have all sorts of issues going on elsewhere in the Middle East, then you can see the price of oil nationally, even here, going up. And in fact, that's what we've seen so far, but I think that is temporary, and it's driven by political factors. So now let's talk now about another issue of inflation, and that is the money supply. You've seen the Fed has been purchasing long-term assets. That has the effect, as people have said, of printing money, and people are then worried that if all this money is being printed, it will lead to inflation. But what happens? Let's walk through it. The Fed buys a mortgage. Who do they buy it from? They bought it from Eastern Bank or from JP Morgan or Citibank or any other bank. So cash goes from the Fed to Eastern Bank, let's say. That's where the money is so-called created. What have the banks done with that cash? Well, for the most part, they haven't lent it out. They've simply stuck it on deposit in their bank, which is the Fed. So the money is just sitting there doing nothing. It has not helped the economy all that much. And as a result, the overall amount of money in circulation, which is the purple part of the graph, has barely budged. It's only up about 2%. So we're not worried that right now we're going to see a lot of money in circulation, and therefore we're not really worried about a lot of inflation. If we were to see the banks starting to pull money out of the Fed and lend it, and we saw dramatic loan growth, then yes, we might be worried about getting into an inflationary spiral. Of course, the people on the other side of that are the Fed themselves. They would see that, and they would be able to step in very quickly with whatever tools are necessary to restrain us and other banks from being too aggressive. For example, they could raise our capital requirements, or they could raise the interest that they pay banks to keep money at the Fed, or many other things.